Good day, everyone. I'm going to be presenting and then handing over to Ivan later on to cover a financial section. If we could kick off. So, Datatec is an international ICT group, and we operate 3 lines of business, and all of our divisions operate in a similar sector within ICT, but address different areas of the market, such as supply chain distribution, integration services, and management consulting. And we have a brief sort of deep dive on those divisions in a moment. We have partnerships with most of the leading vendors in our segment, and increasingly we see working with vendors such as Microsoft as a key enabler for our growing cloud solutions going forward. We're in over 50 countries, but approximately half of our revenues, gross profit, and our people and assets are based in and derived from Europe. We have over 10,000 employees across the group. So next slide. This slide, in terms of the share price movement, I'll address in a moment. It needs a bit of explaining. In terms of a snapshot of the business today, we're a business of 4.3 billion revenues. In our last fiscal year, we did 159 million EBITDA. We have more recently reported our first half, and we're pretty much tracking a similar performance as of last year. Seasonally, our second half is generally better than our first half, and I'll obviously explain how we've fared, so far this year, which has obviously been a challenging environment for many markets, many businesses, and many economies. But we are generally, of course, driven by the tech dynamics, certainly in the areas that we operate in: networking, communication, security, cloud migration, and so on. These segments have remained, very robust during this period as organizations and users lean on technology for, as a means to, continue efficient operations. The top right-hand revenue, gross margin, and EBITDA analysis of the last 5 years is for our continuing operations. And the reason I mention continuing operations is that up until the end of 2017, which is where you see the sharp change in the share, or correction in the share price, we were indeed a larger business, and we were about 6.5 billion in revenues. And we sold a big part of our distribution business, Westcon, to a US company called Synnex in 2017, and that transaction closed at the end of that year. And then in January 2018, we had a special dividend to shareholders of $350 million, and in the subsequent 18 months or so, we returned a further $140 million to shareholders through a share buyback program. So in effect, post that transaction, we have returned close to $500 million to shareholders. And just as a valuation point in context, at the time we did the sale of Westcon Americas, which was half of the revenues and assets and people of Westcon, but the majority of the profit at that time, we sold that business to Synnex. I think it was just over $600 million, which at the time was in excess of our market capitalization. So I just want to kind of footnote that, because obviously that explains the sharp change in that share price, and we haven't rebased this chart. So I'm going to move on to the the summary of the various businesses. So, subsequent to the sale of Westcon America's distribution business, the distribution business is no longer the largest segment in our reporting. We have become much more biased now to services as a consequence of Logicalis, the IT solutions and services business, now being the dominant contributor. We've decided to show on this slide the contribution from gross profit down through EBITDA, because we think that's more relevant. We're obviously a large revenue company with relatively relatively slim margins as a services player and distribution organization. And the dollars we bring in the door, which is measured by, of course, our gross profit, is, sorry, I just read something, sorry. You'll need to ask that question. You need to ask that question, Michael, because I missed it.
We'll answer that question at the end of the presentation.
Oh, sorry. Yes, sorry. The portrayal of gross profit we think is more relevant because obviously the dollars we bring in the door. But just by example of what I was talking about in terms of margins, in our IT services and solutions business, Logicalis, our gross margins are about 25%. In the distribution segment, they are 10 or 11%, and in the management consulting space, they're close to 40%. So the margin profile is completely different across the group, obviously relative to the value we add and the services we deliver. Our services business is by far the largest in terms of employees, over 7,000 people. Our distribution business, 3,000 people, and our management and strategy consulting business, just over 300 people. What we do in Logicalis, our IT solutions and services business, we act as a prime contractor and an integrator. We represent technologies in the networking, data center, security, cloud integration space, and we we prefer to offer full life cycle services to our clients, which include design-in, professional services, implementation, and project management of the IT assets and infrastructure, and ideally longer-term managed services contracts, which is a growing part of our business. And I'll touch on that in a second. In our distribution business, similar industry sector, we represent many of the leading networking, security, communications manufacturers. And in this business, we take our products to market as a distributor through a wholesale business model. And the clients we sell to are telecommunications service providers, large global integrators. But the majority of the business we do is through small and mid-sized resellers across the world in every country that we operate in, numbering thousands of these intermediary partners and resellers that we supply. In our management consulting business, again, very telecommunications networking focus. We are very focused on that TMT sector. The majority of the customers here are telco, service provider, some government, some regulator, some enterprise, some utility, but the majority of the business is fixed and mobile operators. At the bottom, we show a selection of publicly traded competitors in each of these lines of business. I don't have to read through the names, but we've taken a snapshot of players in the Logicalis space, of which there are many. There are hundreds of players in that space. In our distribution line of business, less so. There's been a lot of consolidation in our industry in the last few years. Tech Data this year was the largest global distributor, was taken private by Apollo. Ingram Micro, previously a company that was listed in the US for over 20 years, was taken private by H&A Group 4 years ago. Arrow Electronics is a long-standing name that's still on the list here. Also is based in Switzerland. ScanSource based in the US. These are the large competitors of Analysys Mason. But as I mentioned, Analysys Mason would typically be a practice area within those large organizations. We're only focused on technology and technology, networking, and telecoms. Next slide. This is not company. This is not really company or divisional specific. It just shows you a depiction of the partnerships we have with leading technology providers, and it also shows you where we're active. We are not. We don't have any consumable or consumer exposure in our business. We don't distribute or sell, Apple phones. We're not involved with high volume IT products in terms of PCs, laptops, peripherals, printers, consumables. We don't really touch any of those, let's call it mainstream, fast moving IT products. We are very much in the network, the data center and communications infrastructure, and operate within those spheres shown in the upper right quadrant of this chart. So moving on to Logicalis. These are our main business domains today. As I mentioned, we do come from a background of our heritages in networking and data center design and implementation. Of course, increasingly, organizations are no longer building their own data centers, and indeed, they're not running their business, their IT on their own, very often not on their own dedicated hardware anymore. That has all migrated to either the cloud or externally to third-party hosting providers. So we ourselves have been involved with that shift and journey, and that, of course, is creating a different business mix within this line of business. It's becoming less product orientated and more software and services. In terms of where our business is, how our business is spread geographically, you'll see three regions which are largely similar in terms of revenue, close to 30% each: North America, EMEA, which is mainly Europe for us, and Latin America, with Asia Pacific being about half of that in comparison. The revenue mix doesn't correlate directly to our EBITDA contribution. We are particularly strong in Latin America, and while Latin America represents 30% of our revenue, it represents 50% of our EBITDA, and the reasons behind that are multiple. We've been in that region a long time. We have a dominant position in certain markets, especially Brazil. We've had an early mover advantage, which goes back over 20 years. We have overwhelming market share in some segments, such as with Cisco. We deal with significant large enterprise customers, especially telecommunications operators, banks, some retailers, mining companies, and a bit of oil and gas. And we have a very strong position in that market. In the other markets that we're in, we tend to be more of a mid-sized market participant. And the competitive dynamics, obviously, in the US and across Europe are different to what they are in Latin America, certainly in terms of the number of players and competitors. So in this business, we basically act as a prime contractor. As I mentioned before, we engage the customer at the beginning of their IT life cycle. We have been growing our services mix in this business considerably over the last 5 years. If you go back 10 years ago, we were an 80% product company, mainly hardware with some software, and 20% services. And as you can see in the first half, in fact, if you extrapolate this forward a year or two, it would be quite easy to imagine that we become a 50% services business and 50% product or capital equipment. Really, that's in the red segment. We don't envisage that the products or the capital equipment is going to go away, but we do think in the new cloud model and mix going forward, the relevance and proportion of hardware and software, certainly sold as capital equipment, will continue to diminish. It won't disappear, because obviously software and other and business applications need to run on hardware technology, and organizations will continue to buy part of their infrastructure in the CapEx way. But increasingly, IT is being delivered in an OpEx model as opposed to CapEx model, and that is one of the shifts, obviously, behind the growth in services and the way customers and the way our customers, users, want to contract with us. In terms of what's happening within the product revenue category, we basically breaking out that other 50% plus, and we've always shown this, so you can see the trends over the years. It was pretty much, it's been a Cisco dominant technology space for us, and that has been coming obviously because of our networking background, and that's the biggest part of our business. But there have been a number of other entrants to the market, and the industry has become more fragmented, with especially the rise of security and new plays in cloud infrastructure and the technologies involved around getting an organization to move to either Microsoft Azure or AWS or Google Cloud or whatever the solutions, the platforms are out there. And in pursuit of that business, we've had to change and modify the technologies we represent. It's obviously important for us to have this new mix in our business, as it also pulls through a lot of those pre-existing or legacy platforms and infrastructure that we've been selling, which are equally as relevant in a new cloud-orientated world. But the way these technologies are delivered and implemented, obviously, it has they all have different relevance now in terms of the constellation of IT spend. So I can address that further on if needed, but that's the representation of our current business mix and trend. So moving on to the financial performance. This is a snapshot of the last 3 years. In general, what we've seen in this business, as there's been this trend to more services and annuity in the last 5 years and less product intensive, that has had a muting effect on our revenue growth. In fact, that's most probably been the case now since 2014, 2015, since the rise of cloud. And the reason for that muting effect on revenues is that we are increasingly writing business, which results in multi-year contracts. So the revenue recognition might be less upfront, but the stickiness or the tail of the business is much greater. So this trade-off between revenue growth or lower growth for higher services content or stickier revenue streams, in a way has helped us. It's improved our predictability. It's supported margins. In fact, it's improved margins, and it's also helped in certain areas with cash generation. And the bottom line is the business has become, or businesses in this space have become, less transactional and less lumpy, according to whatever have been previous capital equipment cycles. So the industry is shifting, and we're going with it. We think we've adapted pretty well. As you can see, we've had a rise in gross profit over the last 3 years: 390, 410, 441. The 441 is closer to 425. You have to back out 15 million of a one-off tax credit, which appeared last year in Brazil. So you have to really perform that out, but then you'll still see steady progression. And at around 25%, our gross margins are pretty much best in class. Similarly, our EBITDA margins have made good progress over the years. Maybe there's a little bit more to come as we continue to shift more and more into services, but overall, a reasonably pleasing picture. And even with the headwinds that economies have experienced in the first half, we did relatively well. And a big part of the slight drop in H1 performance is all around currency, because obviously we have meaningful contributions coming from markets like Brazil, the rest of South America, parts of Asia, such as Indonesia, where currencies have been very weak. So that's basically all in the numbers that we report here. So moving on to Westcon, this is the more transactional side of our business. This is a distribution business. Having said that, there's also a rise in recurring revenues and annuity in this business, which I'll touch on in a second. We have a pretty broad footprint here. The transaction I referred to earlier in the presentation is we sold our Westcon Americas business to Synix in 2017. At the time, their interest was in the whole world, in the Westcon worldwide, but we couldn't get to what we thought was a fair valuation point on the non-Americas business. So we ended up doing this sort of carve out where we kept the rest of the world, and we'll go on to show you here why we think that was the right thing to do and what we've done with that business. And at the time we sold Westcon Americas to Synix, the rest of the world had been suffering from a transition that had taken quite a long time, which was to SAP, and we'd had a lot of business disruption as a result of that. And to further compound those transition problems, we'd also decided to go to a business process outsource model in Europe and Asia, which turned out to be very, very disruptive. And we unwound that about 2.5 years ago, after we separated the Westcon Americas business and sold it to Synix. So we're still in over 50 countries. We have logistics and integration and staging facilities in major hubs around these, not in all, but around some of these 50 countries. Europe was driving close to 2/3 of the revenue mix. It's 61% in this period. Asia Pacific, which includes Australia and New Zealand, of course, has picked up a bit, as has the performance in the Middle East and Africa. And what we essentially do is we represent these manufacturers here, which are, basically represent about 80% of the business, but we also represent another 50 or 60 manufacturers, and much smaller players, mainly in the security, wireless networking, remote access, cloud infrastructure space. But these names that we've pointed out here provide the bulk of the business that we represent. We represent these manufacturers, and we are their supply chain in all these markets. It's competitive. There are other players, but we're very focused on this segment. In terms of the analysis of what those vendors provide, we've long been known as a networking distributor. However, in the last 3 years, that has really shifted. Networking now represents 21% of the total business mix, and security, which is basically was an adjunct of the networking space, is now almost double that. And of course, in that security segment, you have Cisco, which is of course by far the largest networking player, but they're also a significant player in the security segment. So we're showing our business here based on technologies as opposed to particular vendors. You can move on to the next slide there, Ivan, just quickly. So I mentioned that what the underlying business is changing here as well. It's really the underlying business mix. The role of this business as a distributor, which is essentially to represent manufacturers and take their products to market, whether it's hardware or software, whether it's physical or virtual, the role of a distributor doesn't really change. And those requirements for credit, inventory staging, and supply chain management are equally as relevant in a software world as they are in a hardware world. And what we've seen in our business, and in particular the rise of security, which is mainly a software-led solution or industry, there's been a dramatic change in our business mix. We're becoming less hardware. We're becoming, and as a result, asset lighter. We're obviously still asset intensive business because we're a distributor, but what we sell is less physical and more virtual, more software. So the inventory needs are reducing. The working capital needs are slightly less per the same amount of given revenue. And you can see that software has gone from 14%. In fact, 10 years ago, it was less than 10%. And we expect in the next year or two for that to be more than 40% of our mix. And that increase in software is also changing not recurring necessarily, but the business is capable of being renewed. That's why the top right here, we're not showing annual recurring revenue. We're showing business that's capable of being renewed. And basically, most software now, it might not be contractually renewable in terms of the agreement of supply, but in practice, unless you stop using something in the software domain, you have to keep paying for it. So what we're showing here is a large part of what we do, whilst it might not be contractual annuity, it's recurring or renewable in the sense that customers will have to keep assuming that we stay in the supply chain, which is very high probability unless the customer decides to use something else. We're going to stay in the supply chain or ecosystem of that software path for as long as the customer keeps using the technology. So, very good turnaround in this business. 18 was the year after we decided not to sell this line of business, and we thought we could do much more with this business. The rest of the world outside of the Americas, we refer to it as Westcon International. In 2018, the EBITDA loss was 48 million. At that point, we were carrying significant head office central costs that had previously been servicing the whole world. And of course, we had to right size that, which we did in 18 and 19. We roughly halved, in fact, more than halved our central cost apparatus, which is mainly the IT required to run the business around the world. We also sharpened up our execution. We returned to normal operations after years and years of business and system migration and business process outsourcing interruption. We repatriated a lot of the functions that we'd previously outsourced, and we really got on top of our SAP implementation, and that's turned from being a handicap to a benefit in the last 2 years, and it's really helped us this year, especially in the post-COVID environment. We've actually turned to technology and our SAP platform and other technologies, and we've had to rely heavily on technology in the running and operation in our own operations, as we've been able to quickly virtualize many parts of our business, and that I guess accelerated digitization now of our business and our own technology automation has really started to come home, and we're starting to see some of the benefits, mainly through reduced operating costs, as we've been able to, as I say, automate in many parts of the organisation. Our gross margins have been very steady in this business. They've been down a little bit in our first half, but that's due to there's been some rebate pressure, and there's been pressure on increased freight costs and things like that as a result of the pandemic. But generally, our gross margins are well underpinned, and we don't see any systemic erosion, given our business mix that we showed earlier. And we had a very robust first half. We're on track to meet or exceed what we did last year, and that's all down to the relatively strong emphasis that's being put on our industry at the moment in terms of organizations accelerating their move to the cloud, and digitization that requires a lot of the communications and networking technologies that we provide. So I will just jump onto one slide very quickly on our strategy management consulting business. We provide in this organization research and strategy consulting to mainly telco operators and service providers. That drives about 60% of the business, but we also provide advisory services to large network users in terms of enterprise network users. So it could be utilities and railway organizations, or logistics, transport organizations, and also private equity. We're advisors to private equity that are increasingly active in this space in terms of consolidation and investment activity. One of the big drivers for us, we're just showing the EBITDA here. Obviously, the relative revenue numbers are very small compared to the rest of the group, but the EBITDA is meaningful, and it's certainly worth observing on the jump in the last 2 years, which has continued into this year. And most of this has been propelled by a couple of small tactical acquisitions we've done in the Nordics and in Germany. And the other thing that's really helping drive this business, which is thematically, which we think will continue for a number of years now, is the rise and acceleration of 5G adoption in most markets, especially so in Europe, where we have our strongest presence. So I will hand over to Ivan, who can take us through, will take you through the consolidated financial picture and some salient balance sheet data.
Thank you. Thanks, Jens. So we've seen continuing improving financial performance over the last 3 years. Both our gross and EBITDA margins have expanded, and the expanding margin trend across all 3 of our divisions is due to, firstly, cost efficiencies, secondly, investment in systems and processes yielding benefits, and then thirdly, as a result of the business mix evolution. The biggest improvement that we've seen was in Westcon, and margins have improved after years of SAP implementation disruption. And we are targeting further margin expansion in the medium to longer term. In terms of the evolution of our business model, we have seen a significant growth in recurring revenues over this 10-year period. And in particular, cloud adoption creates enhanced services opportunities, specifically in the areas of solution architecture, cloud migration, and managed services. The as-a-service economy is driving integration of hardware, software, and services into bundled managed services. The increase in services as part of the mix supports our margin expansion and is also less capital intensive. Looking at the chart on the left-hand side of the slide, the geographic mix of the group is very well balanced. This slide sets out our recently reported first half results, so the results for the 6 months ended August 2020. And from a group perspective, revenues were down ever so slightly, being down 1% over the prior comparative period, but in constant currency, revenues were up 2.8%, showing the significant impact of foreign currency translation on our numbers. Operating costs were significantly lower, resulting in EBITDA of $61 million or adjusted EBITDA of $67 million before COVID-19 related restructuring costs. And just a reminder, and also to reiterate what Jens had mentioned in the Logicalis section, that the prior year EBITDA included a $14 million once-off benefit, that is $14 million, relating to an indirect Brazil tax credit in the prior year numbers. And excluding the prior year benefit, EBITDA would have shown healthy growth. Net finance costs are also higher than in the prior year, as the prior year benefited from interest income of approximately $7 million relating to the Brazil tax credit that also impacted EBITDA. Moving on to the balance sheet at our half-year stage, the balance sheet continues to remain strong, driven by solid working capital management and a very good working capital performance for the 6 months. Very pleasingly, the collections from our customers have remained in line with recent historic norms, and our suppliers have also assisted their channels by providing extra payment days in certain instances to improve liquidity through their channels during the COVID pandemic. In addition, we recently refinanced our major facilities in Westcon Europe and Westcon Asia, providing additional liquidity at enhanced terms. And we've also successfully renegotiated future covenants in our Logicalis financing arrangements to ensure even more future headroom in terms of covenants. And we feel that these are really major achievements in what is currently quite a difficult credit environment. So basically, overall, liquidity is significantly enhanced from the position at the previous financial year end. And then just a few notes on the cash flow. We had a very strong operating cash flow performance for the 6 months, driven mainly by improved working capital cash flows, resulting in an improved cash position and a reduction in overall net debt for the group. So I'll hand back to Jens to cover 2 more slides, whereafter we can open the discussion for questions.
Well, nothing much more really to present, just kind of wrap up in terms of, well, firstly, the situation today. I mean, we are operating and continuing to plan that we're going to for some time still be living and functioning in a movement restricted world. We think that's not going to change anytime soon, and in fact, when it does change, we think there will be as I mentioned before, there's been an accelerated shift now to the shift to cloud was happening anyway. The digitization in organizations was happening anyway, but there's been an acceleration of that, and that acceleration, I think, has tilted more to what will permanently be now a more remote enabled world. and of course in the remote enabled world, we think some of those business themes and sectors will, strongly be in areas that we are operating. We continue to not only work towards improving our own business optimization, but we're also continuing on this path of modernization and digitization, and especially on the process system side of Westcon, the distribution business. And we think that's going to be there's further gains that we can eke out of the business model in terms of our own efficiencies and productivity going forward. We see, as I say, if slightly enhanced demand in many sectors that we operate in. Clearly, there's going to be a rebalancing now in terms of IT GDP and where those dollars go. I mean, at the end of the day, organizations have finite amounts of investment to make in any area in terms of business investment, but we do think that the mix is going to change. We've got a pretty good international position, international/global position in terms of the countries we operate in. Obviously, two sides to that coin. It gives you're exposed to more geographical areas of business, but you're also exposed to more fluctuations, as in economic drivers, currency, and the like. But that is our business model, and that's what we've been working at for many years. And as Ivan has touched on, we've got strong balance sheet. We're continuing to generate good cash or good cash flow conversion, and that's supporting our investment plans going forward. So just in terms of wrap up, I guess these are the features of our business: global business, over 50 countries. We're very focused on the domains that we know best. We've been in this space or in these segments for a long time. We have deep and embedded relationships with a lot of the leading technology suppliers and vendors, and similarly, we've got deep and embedded relationships with our customers across the world. We've got good brand relevance in all of our lines of business in their respective areas, and our execution is increasingly dependent on the quality of our systems and the way we deliver our business operations. So I'll hand over to questions, and I guess they've been typed in the meantime. If I don't know, Michael, you're going to help, or John?
That concludes the presentation. If you'd like to ask a question, it's on the bottom of the webinar. You can go to the Q&A sections and raise your hand. We'll unmute you and you can ask a question, or you can type in the question. The first question I see comes from Mike Cahill at Crispin Capital. Was the sale of Westcon just to capture the discrepancy of the valuation in your share price, or was it something more strategic driving the sale?
The sale of Westcon in 2017 was a consequence of an inbound, unsolicited approach from Synnex. We had no intention at the time certainly had no intention of separating the business into two business units, which was complicated but not impossible. But it left us with a disproportionately large system cost base and group apparatus, central apparatus. But it was driven by there was overwhelming financial logic in the transaction. So we didn't search for it. But if you look at what we achieved, I think I mentioned it was at the time it was basically we sold two-thirds of our business for more than our two-thirds, I mean, of our business for what was more than our market cap. And if you look at the Americas, the profitability of that business that we sold, I think, was about 95, 96, 97 million dollars, and it had, I think, 150, 200 million of debt. So that was a very, a very significant multiple that we managed to get for that business. I think it was about 8.5 times EV/EBITDA, which is way above what we've been trading at in our in recent history, and in fact is above other multiples of similar transactions in the industry. So we thought it was very compelling, and as I explained, we didn't feel that the valuation that was attached to the rest was worthy of or merit, and we thought we could do a much better job, which we have done. And we've been in this space a long time. Size helps, but size is not everything. You can have a good small business in this space, and you can have a not so good large business. So we're entirely focused on continuing to deliver and optimize the performance now of this division, Westcon International.
Great. Next question comes from an anonymous attendee. Your tax rate is currently high. Why is this, and are there opportunities to bring this down?
Yeah, so essentially, I mean, it's due to two main reasons. The first one is mix, so sort of where the profits are generated. So a large chunk of the profits are currently generated in Latin America, where tax rates seem to be quite high. I think the effective tax rate in Brazil is 34-35%, and then also due to the reason that there have been certain loss-making businesses for which no tax benefits have been recognized in the form of deferred tax assets, and that has been particularly true in the case of Westcon. So a couple of years ago, Westcon had been loss-making, but yet there were still pockets of Westcon where tax charges were incurred. So you had a situation in Westcon where you had a pre-tax loss but a tax charge, which obviously distorts your effective tax rate. So what we always say is our normalized effective tax rate should be in the low 30s, so 30, 31, 32, 33%. It is being distorted currently by the non-recognition of deferred tax assets. The bulk of the unrecognized deferred tax assets are in the Westcon business, and as Westcon profitability improves, we should be able to start recognizing those assets going forward, which will normalize the tax rate.
Thank you, Ivan. Next question again comes from Mike Hill at Crispin Capital. Just talking about the Westcon Americas deal. Obviously incredible deal. Congratulations. Any chance the buyer comes after the rest of your Westcon business?
It's possible. I mean, Synnex, we have a close relationship with Synnex. They own 7% of RemainCo, the Westcon International business. We have a joint venture with them called GDS, Global Deployment Services, where we jointly service our combined top 20 customers around the world. So these are very large accounts like IBM Global Services, for example, Accenture or Verizon or AT&T or these sort of organizations. And there we basically combine our organizations so to deliver seamless around the world service delivery and logistics. But having said that, they don't have much of a presence in other parts of the world. They're obviously a very strong Americas player, in particular North America. So, I mean, I can't really answer that. I mean, we're focused on improving this business, which we've clearly turned around. Management is executing extremely well, and we think there's a ways to go. And at the end of the day, having outcomes for a good business are, it's a nice problem to have.
Thanks so much. Please let me know if there's any more questions. Again, if you'd like to, at the bottom of your screen, there's the Q&A portion. You can either raise your hand. It seems like we have another question coming in. How many years left do you think the cloud migration and OpEx trends have left to run till they mature? Is the question.
Yeah, good question. There is obviously a bit of a lift and shift going on. I mean, we've been around a long time, so we've seen a number of these shifts. I mean, the last one of such a magnitude, I guess, was 99, 2000, 2001, before and after the dot-com boom and bust. But essentially what you had there was rapid industry, I guess, transformation. I mean, this is a much used word, transformation, but transformation happens every time there's a need to change something. But obviously there was a transformation period around the dot-com years as organizations went online, essentially, which was a way of doing business or the way of transacting. This is similar in a way, I guess, that this is a way of, maybe not a way of doing business, but a way of running your business. The cloud migration doesn't change the transaction interface to the client or the customer. So there's no, what was referred to in the early 2000s, there's no B2B or B2C consequences of going to cloud. I mean, none of that changes. What does change is where you run your assets and how you buy or consume IT, and so on. So if you look at what's going on now and try and draw some analogies with the early 2000s, you did have a similar lift and shift migration going on with, say, Microsoft in those days. It was all, it was going from DOS and standalone PC operating systems, and then a thing called SQL Server and .NET technologies came along, and then it was this big gold rush in terms of moving to the early days of Office and so on and so on. So you could say a lot of that is recurring now, where people are shifting from on-premise, traditional Microsoft in the enterprise to Microsoft only being consumed from the cloud and other cloud. I mean, that's just one example, the whole shift to cloud infrastructure. So absolutely, there is definitely a lift and shift window here, which is going to have some kind of bell effect. And we're most probably, we could be 70%, 80% of the way up. And this could go on for a few years. What seems a bit different to 20 years ago is that the curve is flatter, it's taking longer, and it's not a straight either or. It's not do all of this or all of that. So a middle ground has emerged called hybrid cloud, which is where organizations continue to use some of their own infrastructure and don't abandon buying their own CapEx completely and mix it with the cloud. That's one. And the other one is also called multi-cloud, where you do abandon everything and go to the cloud, but you don't go to one cloud provider. You might go to 2 or 3. And of course, again, where you go to 2 or 3, you need organizations like us in terms of supply of technologies, because you need to connect up all these different environments. You need more comms, you need more security. And then on the services side, as I explained before, we're seeing this flattening of revenues as product sales go down, but services go up. But so all in, netted in, absolutely, there's going to be some rainbowing at some point when organizations have moved to the cloud. They don't have to keep moving to the cloud, they've already done it. But then you'll find that there'll be then this, I guess, tail of other activities and continuing automation and modernization and so on. And this, who knows, with 5G, I mean, I'm jumping on a totally different theme, but with 5G and the re-emergence of what will be, high-speed wireless, in very robust broadband on campus, in premises, on enterprise, so in a business environment, a shopping center, a university campus, a hospital, there could well be at some point a repatriation of functions away from just being in the cloud and being brought back again into local, let's call it IT communities, without the need to have to keep going in and out of a cloud world. So I think there are there are many. At the end of the day, what we like is complexity, a bit of confusion, and strong innovation. Those are the things that help us. What we don't like, so innovation is our friend. What we don't like is if it all went Microsoft, or it all went to one situation in the cloud. But that's not going to. We don't think that's going to happen. I mean, then there would be no differentiation between what users and companies operate on, and I don't think that's ever going to change. For some businesses, IT and technology is strategic. For other businesses, it's like tick the box, you must have it.
Okay. Thanks, Jens. Next question. Looking at a sum of the parts analysis, it looks as if a significant conglomerate discount is applied to the valuation. Would management consider carve-outs to release value for shareholders?
Well, we continue to examine many things, and we've shown. I mean, we're not a company that we're not a business organisations that we're not wheeler and dealer of assets. We don't buy and sell, but you know, we're an operating company. We've done far more acquisitions than we have disposals. When we look at things like we did with the Synnex transaction, we take our time to evaluate what the long-term implications are versus just the short or medium-term business or value realization. But I can't give you a specific answer other than we're working on the most important thing, which is ensuring we've got good businesses. And I think secondly, we will continue to examine ways that what we can do about the valuation gap or valuation discrepancies that we're currently under.
Thank you, Jens. Please, again, if you'd like to have any more questions, they will be, you can go to the bottom of your screen on the Q&A, either raise your hand, we can have you speak to Jens and Ivan, or you can type your question in. I'll give you guys a couple more seconds, and if no one has any questions, we can conclude the presentation. All right. Well, thanks very much for attending.
Thank you very much, everyone. It's been thanks for your participation.
Great. Oh, I'm sorry. We just have one more question that came up. Apologies.
Sure. Don't worry.
Does the company continue to look for new vendors to work with? Example, Commvault and data management.
Yes, absolutely. On the I don't want to say more. It is more so on the distribution side, because basically we are a vehicle for representing technologies and taking them to market. So we need to make sure that we're always representing latest technologies, and in fact our business development or R&D in our distribution business is really talent spotting new technologies, and we have an impressive array of new vendors that we've launched in the last few years, especially in the security segment, which is very adjacent to where we come from. And as I mentioned before, we are starting to look now at areas around 5G. We think that's going to be very interesting. But again, you know, we need to wait and see where we're not leaders really. We need to follow in that market, but not follow too late. We need to be able to identify trends, wait till they have shown themselves to have traction, and then we go and look for vendors. It's really a balancing game. You don't want to get in too early, because then you end up, you know, we're not really in a position. We don't have the margins to go out there and do a lot of pioneering. But the flip side is we have better you might think our margins are low, but they're twice the size of some of our competitors that are even more reactive, let's say, than we are. So we're the sort of proactive end of our industry. We have to continually look, because we're a niche player, we have to continue to look for the most relevant technologies in our space. But yes, I mean, that's a bit of a long-winded answer, but I think, you know, between now and the end of the year, you're going to see us make some, you know, quite important new vendor announcements in the distribution side. On the services side, it's a bit different. The technologies and the manufacturers we represent, yes, of course they're important. There was a slide there that showed Cisco, IBM, Oracle, HP, EMC, Dell. You know, these are all let's call it the legacy names, which themselves are reforming and transforming their businesses so they are more relevant for what's needed going forward. But there was another segment there called other, which I think was about 28% of the business. And we haven't broken that out because it would just the slide would be too busy. But in there you have a plethora of security, all in the cloud companies, you know, blah blah blah, that underpin what, you know, let's call it the raw ingredients of what we're putting together on the services side. But on the services side, we tend to be more technology agnostic and more driven by what the customers want. At the end of the day, we need to make sure that we've got the right repertoire of skills, not necessarily particular vendors or manufacturers, and then that sort of follows through, and you end up sort of coalescing around a few key technologies, and you learn in different countries and different regions. You know, you basically adapt yourself to what your customers want in terms of what they're using.
Great, thanks so much, Jens. Any more questions? We'll just give it a couple more seconds.
Thank you very much.
Thanks very much. I appreciate you attending the webinar today. Please feel free to contact myself or the Datatec team. All the attendees on the webinar today will receive my email, and any follow-up you'd like to do, just please pass through me, and I'll make sure that the Datatec management gets these messages. So thanks so much for everybody for attending. Take care.